David Edwards, Heron Wealth in New York City, Buff Parham in South Carolina, Parham and
How are
Associates.
you?
We are doing our end of the year webinar, and I decided to entitle this webinar 2022, the year of jumping sharks.
Mm.
And if anyone is not familiar with that reference, it came about from the TV show Happy Days back in the 1970s. Very popular show. I watched it when I was a kid. And after a few years, they started running out of good ideas for plots. So Henry Winkler, who played the character of the Fonz, said, well, I'm a really good water skier. How about we have this concept where I jump over a shark tank as a dare? And the director and producer said, that sounds like a great idea. So they did it. And actually, that was 1977. And 1976, Happy Days was the number one most highly rated show on TV. 1977, the year of jumping the shark. It was the second highest rated show. When it finally went off the air in the early 1980s, it was 63rd. And so people said, yeah, Happy Days was a great show, but eventually they ran out of ideas. So to keep the thing going, they had to come up with all kinds of crazy stunts. And so that concept of jumping the shark has been applied to many creative endeavors over the years, also personalities, but you could also use it for analyzing investments. Everything is a trend until the trend starts to peter out. They love you at the beginning, and then they hate you at the end. And where does the differential occur? So we're going to spend the next half hour talking about a number of important trends of this past year and discuss those that have jumped the shark and those that still have a way to go. And Buff, why don't you start jumping in with some of the questions that we got?
Well, I think we should start with the number one topic of 2021, which is COVID-19. What do you think?
Yeah. So I started these webinars in March 2020 because we were frantic about COVID. We didn't know what it was. We didn't know how it would kill us. Did we have to wipe things down with bleach? Did we have to get gas masks? What was it all about? And it was a pretty bad experience for many Americans. Half the population got COVID, 1.1 million died. Well, I finally got COVID last month. Mm-hmm. And the only reason why I know I had COVID was because I wanted to fly down to Florida to spend Thanksgiving with some friends. And I took a test in advance and I tested positive. I go, what? Yeah. And I got a better test, and I was still positive. It turned out that I had picked up COVID somewhere along the way, which has been the experience of a lot of people this year. But because of science, because of vaccines, it was nothing for me. Mm-hmm. And I've heard from a number of other friends and clients in the last 6 months or so that all got COVID after avoiding it for the first 2 years, right? All diseases become more transmissible and less lethal as time goes by. Mm-hmm. If the disease doesn't transmit, then it dies out. If it's too lethal, it dies out. So the first strains of COVID were not super transmissible, but extremely lethal. And now it's very transmissible, but not so lethal. And it's right up there with flu and RSV and a couple other things for inconvenience. So we've gone from the pandemic stage of the disease to the endemic stage of the disease. People will be dying of COVID still. We'll be getting annual vaccines going still. But thanks to science, thanks to vaccines, it's no longer a significant part of our world. It has jumped the shark.
Amen to that. Well, while energy prices, at least gasoline for that matter, have come down dramatically, the broader inflation number hasn't followed suit. What's going on?
Yeah. So energy prices plummeted to negative in April 2020. One of my clients called up and said, "Hey, David, can I get some of that negative gasoline?" I said, "Absolutely. If you don't mind storing it in your basement." And then gas prices rebounded from zero to, let's say, $3 a gallon, and they'd probably be at $3.50 a gallon throughout the whole year, except that the war broke out in Ukraine. The Russians invaded and disrupted European energy markets. And we talked earlier this year about how it takes time for energy markets to reconfigure. Okay, so the Russians aren't shipping their oil anymore to Western Europe, but they are shipping their oil to India and China, which means that the Indians and Chinese are not buying oil from the Middle East. Meanwhile, the Americans ramped up their production. So energy prices bumped way up because of supply constraints. And then supply adapted, world trading patterns changed, and now prices have gone the other way. So just in the last month, the price of gasoline fell to a level lower than this time a year ago. Now, it still takes time for inflation to work its way through, and there are other things going on with inflation. So we're not dropping right back down to the 2% that prevailed for most of the last decade. What are the other components of inflation? Housing prices are a huge component of inflation. And it's the rent part, not the buying part. And because the United States has systematically underinvested in new property development for the last decade, we don't have enough housing. And why don't we have enough housing? Well, because many municipalities have such a rigorous permitting process that it's very hard to get new construction going. A lot of municipalities won't allow multifamily houses, won't allow apartment buildings. Well, that's the fastest, best way to get cheap housing out there. But if you live in Greenwich, Connecticut, you are opposed to an apartment building because that would devalue your property. So I don't see inflation from housing going down anytime soon. That's a big problem. And then, food prices, we've had trouble with eggs. Why eggs? Oh yeah, there was an avian flu outbreak. 60 million chickens had to be killed to get it under control. Now we don't have enough chickens laying eggs. The cost of diesel is a huge impact on food prices because you got to pick the tomatoes in California and put them on a truck and ship them to Connecticut. So food inflation will come down eventually. The last piece of inflation this year has been supply chain constraints. China's economy has been stop, start for the last year as they had this, what they call the zero COVID policy. If there was a single case of COVID in the entire city of Shanghai, they would shut down the entire city. And that policy did not work very well. The Chinese are very vulnerable to COVID. Huge surge right now, could potentially lose 1 million people. But also it blew up the factory business. And then all of a sudden you can't get stuff from factories to ships, from ships across the ocean, from oceans to California, from California onto a truck, from a truck to Kansas or Chicago or Florida or any place. So all of these things have created inflation, and I call that war inflation. War from the Ukraine and the war from the pandemic. But good news, inflation was 9% earlier this summer. It's fallen back to 7%, 7.1. It will continue heading south as we get into 2023, probably to 4% is where it will be. And then after that to 3 and then 2%. So, it took a while to ramp inflation up to 9%. Mm-hmm. It took a while to drop it back down to 3%.
Well, how big a role is the Fed's manipulation of interest rates playing right now?
Yeah. So historically, people thought that, the Fed will just raise rates and that will slow down the economy and everything will be fine. Well, raising interest rates doesn't fix the war in Ukraine. Raising interest rates doesn't fix supply chain problems in China. Raising interest rates doesn't, affect grow more chickens. Mm-hmm. So kind of the Fed is as much a spectator on inflation as the rest of us. The Fed raised rates at the fastest, sharpest rate in the history of Fed raises. We had 4 increases of 75 basis points. We had another increase this past week, half a percent. A couple of increases earlier this year. So we went from 0% to 4.5% in a very short time frame. But the economy does not seem to be that affected by it. The one part of the economy that is affected is housing prices, is mortgage rates. Mortgages were 3% at the start of the year, now they're 6%. Yeah, that's definitely put a damper on home sales, and house prices are coming down a little bit. But again, there's not enough supply of houses, so it has only modest effect on inflation.
We've watched the tech sector led by the FANGs dive by percentages that are double that of the S&P this year. What do you think the primary factor of that spectacular downturn was all about?
The FANG stocks are Facebook, Apple, Amazon, Netflix, Google, the large cap growth stocks. They were the one decision stocks to buy for much of the last 5 years, soared to $1 trillion market capitalizations. from the start of the year to this past week, they fell on average 43%. And Apple was doing the best. It was down about 27%. Facebook was doing the worst, down about 67%. And the way of understanding why these stocks can be flying so high and then falling down so sharply has to do with the different kinds of companies that are out there. So there's 4 kinds of companies that we can possibly invest in. The first is what we call a question mark company. It's a great opportunity, it's growing fast, but it's cash flow negative. Mm-hmm. You don't know if it's going to survive, right? Tesla is still a question mark company. It's growing very fast, but it's cash flow negative, unprofitable. The companies that are more interesting to us are what we call the shooting star companies, the rising star companies. These are cash flow positive, very profitable, and growing very fast. And that is Amazon, that is Apple, that is Netflix and Google, right? Facebook. But the problem is they can only grow so big so long. Now that Amazon has taken over all of retail for the United States, where are they going to grow to? So every rising star company transitions from rising star to cash cow. Still profitable, still cash flow positive, but growing at a much slower rate. So Microsoft is a cash cow. JP Morgan is a cash cow. IBM is a cash cow. And when you go from rising star to cash cow, the price that the market's willing to pay for your future earnings drops off dramatically. So we talk about PE ratios, right? So let's say Amazon has a PE of 40. For every dollar you put in to buy Amazon stock, it takes 40 years to earn that back out of earnings. Mm-hmm. Well, if the earnings are growing very quickly, yeah, you'll be patient for that. But once the earnings slow down, well, now the PE drops to 20. I'm only willing to wait 20 years to get my dollar back. And so you get a big downshift in the stock price as it goes from a 40 PE to a 20 PE. But then there's things that are specific to certain companies. So Facebook's model, I think, is not a very good model, their business model. There's 2 companies that you can invest in, Google and Facebook, that both do online advertising. But the difference is that, hey, every time I want to buy something, I use Google. Mm-hmm. Right? I go and actively search for it. Mm-hmm. But in Facebook, I'm there for some other reason. I'm looking at my friends' baby pictures or trying to organize a college reunion, whatever. And then there are peripheral ads on the side, but I'm not interested in those ads. I'm not looking for something right now. So I don't think Facebook, even though Google and Facebook are both dependent on advertising, I don't think Facebook has a robust business model. And then there's other factors. Social media. I think social media jumped the shark this year. Back in 2012, when Twitter and Facebook first exploded into the scene, it was really cool to have a Facebook page, and it was something you look forward to. You could check out your friends' pictures and post about your parties and tag things. It was really great. Well, now Facebook is drudgery. Like I'm organizing a college reunion right now, and I'm going into people's Facebook pages to get caught up with them, whatever. They haven't posted in 3 years, 5 years. They don't care anymore. We used to advertise my business on Facebook. We stopped a couple of years ago because our Tiger clients have lost interest. If I look at my kids' Facebook pages or the Facebook pages of some of our younger clients, they haven't posted since 2014. Mm-hmm. So what used to be fun and thrilling and exciting is now drudgery. Same thing with Instagram. Same thing with TikTok, right? All of Twitter.
Let's not leave out Twitter.
Twitter has definitely jumped the shark.
Yes,
we actually closed down our Twitter page for our business because I don't want my company associated with crazy people, right? We can actually roll into Elon Musk and Tesla as another example of what has jumped the shark. Yeah. Tesla used to be the coolest thing on the block.
Right.
And if you're an East Coast liberal elite, you could signal your East Coast liberal eliteness by buying a Tesla.
Yep.
I don't think you're going to do that anymore.
No, he's been very oblivious to the source of his market, if you will.
Yeah, and it's also, in my mind, Elon Musk used to be like Tony Stark, right? Iron Man, this billionaire scientist who's making amazing things. Well, now I'm looking at how he's running Twitter and wondering, gosh, is he doing an equally crappy job building cars? How am I going to get to that car? But here's another thing that might have jumped the shark this year: gasoline-powered vehicles.
Yes, indeed.
We've been driving gasoline-powered vehicles for 100 years.
Yeah.
And I'm not saying we're going to stop tomorrow. But at the past Super Bowl, there were 7 ads from 7 different mainstream car companies: Ford, Toyota, General Motors, plus a couple of new companies, Rivian, for example, all promoting their electric cars. Audi, right? Cadillac, all have electric cars. Yeah. And so the Tesla kind of looking like a Toyota Prius at this point. It's small. It doesn't have a big hatchback to put all your junk, right? It's a nice backup car, right? If you want to go to a country club or maybe as a commuter car. But as the kind of car you take to Costco or Walmart, you can get other much better cars. So I happened to buy a new car in the summer of 2021, so a year ago. I'm reasonably confident that's the last gasoline powered car I'm going to buy for the rest of my life.
I think you're right about that, and we don't know, but if they were to do a survey of asking people, what do you think your next car purchase will look like? My son sells Audis, and he says the EV demand is off the charts.
Absolutely. When you have an electric car, you don't need to worry anymore about if gasoline is going up or down. Most people can put a grid on their roof and power their car at home every day.
Yeah.
And by the way, as I drive across America, I see more and more solar installations on roofs, more and more windmills everywhere.
One more head spinner here: the implosion of crypto.
Yeah.
And obviously the FTX fiasco is drawing a lot of attention to it.
Yep.
The obvious temptation to say, "I told you so," but do you think the regulators have waited too long to step into the mess?
I absolutely forbid my clients to get involved with crypto.
Good for you.
I said, if you want to buy crypto, you can do it on the side, or you can fire me first. I won't let you buy crypto. Well, why not, David? All the cool kids are buying crypto. I go, yeah. Well, let me describe the business model for crypto. It's worth nothing. It requires an incredible amount of energy to keep it going, but you can lose 100% of your money overnight. What are you buying there exactly? So trends come and go, whether it's crypto or Beanie Babies or Dutch tulip bulbs or South Seas stock. There's always a fantasy investment that if you just buy it, you'll solve all your problems. It's time, tale as old as time. And the Bitcoin market peaked in January 22, so 12 months ago, and it was worth about $3 trillion. Now it's worth maybe $750 billion. So we've had about a 75% loss. The two cryptos that are still kind of hanging in there are Bitcoin and Ethereum, but Bitcoin fell 20% when Sam Bankman-Fried or Sam Fried-Bankman, I can never get it straight, announced that his company was fake. And I love when people said, he was worth 32 billion, now it's worth zero. No,
he wasn't.
He was never worth 32 billion. He was always worth zero.
Well, and the problem is that crypto doesn't fit all of the criteria being called a currency, in the sense you can't transact with it. And maybe it's a storehouse of value, but you can't transact with it.
Well, you can't transact with it, and it's not a store of value because it can disappear overnight.
Yeah.
So anyway, I've told anybody who has a fantasy that somehow we'll all come back, I said, no, just dump it at whatever price you can get and move on.
Well, compared to the rest of our shark jumpers, Trump seems like an old movie at this point. You think his power has peaked, and what will that mean to the GOP and the country in general?
Yeah. That guy has more lives than any cat you could ever imagine.
It seems that way.
But you know what? I don't feel like talking about the guy anymore.
Right. Exactly.
I think my one comment was, here he is nominally running for president, and the most exciting announcement he could come up with was a bunch of shitty cartoon cards. that he hawked for $4.5 million.
That's jumping the shark.
That's definitely jumping the shark. And I think what he needs to worry about is the response of someone like this guy who was one of the January 6th insurrectionists who tweeted, "Oh my gosh, I'm going to jail for an NFT salesperson."
And by the way, the images of those NFT cards were stolen.
Of course they were. Because Trump only hires the best illustrators.
Cut and paste, right?
Yeah. Before we go on, let me make one comment about Trump.
Yeah.
He is running for the presidency again. It's not inconceivable he would win the nomination. Mm-hmm. Right now, the Republicans are trying to decide DeSantis's and Cruz's and Rubio's and Graham's whether they should hold off another 4 years or jump in now. Certain polls have DeSantis way on top of Trump, but we're still 2 years out. And I can think of many other Republican governors like Jeb Bush, Scott Walker from Wisconsin, Chris Christie from New Jersey, who had a lock on the nomination, and it never happened. And the thing that will hold DeSantis back is he's just mean. Nobody likes him. He won a pretty sizable victory in Florida against pretty much no competition. I don't know how it's going to pass going forward. So it could be Trump in 2024. It could be DeSantis. It could be somebody else. It seems like Biden is going to announce that he's going to run for a second term. Do you remember those happy days when you tuned into the presidential election about 3 months before it happened?
Well, one more thing is that it's not highly noted, but the Republican primaries are winner take all, and the Democratic primaries are proportional. So you can win a Republican primary with a plurality as opposed to a majority.
Yep, that is exactly true. That is exactly how Trump won last time around.
Yep.
He won maybe 35 or 40% of each primary, but it was enough to put him in front.
All.
And back then he was new and interesting, and nobody quite understood how many lawsuits and criminal indictments he would pile up in the next 4 years, including 4 more today. So I don't know. I don't know what's going to happen 2 years from now. It's a little concerning. It'd be nice to know that the government is in good hands. I feel like it is right now because things are sane, and we'll see in 2 years.
We love normal. Well, are you ready for the pièce de résistance?
Sure.
You have give us 5 key predictions for the coming year, and this is being recorded.
Mm-hmm. Yeah. So predictions by people like me are fun to look at in hindsight. This time last year, I predicted that the S&P 500 would be up 4 to 6% by the end of 2023. Oh, I'm wrong by about 20%. Right now, the S&P is down 18% on the year. Mm-hmm. What's interesting is that the Russell 1000 growth component, the Facebooks and Apples and Amazons, is down 29%.
Yep. But
the value component, it's only down 10%. And actually, IBM is up 18% this year. Interesting. What that means is that growth and value stocks go in and out of favor over time. There was about a 4-year stretch where growth was the style that won, but then value had its comeback year. Even so, now that I was so wrong on the S&P 500 for this year, I'm going to boldly say the S&P 500 will go up 15% next year.
Wow.
The reason why I say that is because we follow a certain model, the Morningstar fair market value model. That's reasonably predictive over time. And right now it's 15% undervalued. Okay. And then on top of that, corporate earnings, while a little bit off the peak that they saw in the start of the year, are still coming in 7 or 8%. So you've got a boost from earnings, you've got a boost from being undervalued. That pushes the stock market higher. And then in interest rates, I think we have seen we're close to the end of the raise for interest rates. I think the Fed has another 1 or 2, maybe 3 raises left in them. Take it another percent and a quarter higher, and then stop. Well, that takes us to the level that prevailed from 2000 to 2008 when the economy did just fine.
Yeah.
So that will help. The stock market this year held down by those rising rates. What's this in the rearview mirror? Looking forward, earnings up, interest rate stable. Hey, market should go up. Inflation, I feel like by the end of 2023, we should be back down to 4%. It's going to take a while longer to get back to 3 and 2%, because now people are accustomed to raising prices for their products.
Yes.
And people are accustomed for asking for bigger raises. And if they don't get them, they jump to a different job. Oh, and by the way, they can do that because unemployment is still down around 3.5%, which is a multi-generational low. So my last forecast is about a recession. Every economist you can imagine has been beating the drum all fall about the horrible impending recession that's coming down the pipeline. And I'm like, show me the data that says we have a recession going on, right? Because normally, one of the first clues about an incoming recession is a sharply rising unemployment rate. It's been flatlined the whole year. Oh, and by the way, there's 2 job openings for every 1 person looking for a job right now. Oh, by the way, because of some of the Biden administration legislation, we are bringing high-powered jobs back to the United States. For example, 10,000 jobs in Arizona to make chips.
Yep.
Right. What did we learn from the COVID pandemic? When your chips are being made in Taiwan and you got to get them across the ocean, a lot could go wrong.
Yep.
So let's bring some of that high-tech manufacturing back to the United States. So I think, oh, you know what else interesting? The most recent GDP report was 2.9%. Not negative. You need negative GDP to be talking about a recession. It was 2.9%. That was the highest rate of growth compared to the entire Trump administration. Really? So we got no data that says a recession. So I think we'll skate right by that recession next year. Inflation comes down, stock market goes up. We're pretty good. Let me close on one other thing. And normally we would take questions, people, but we're running late, and we never try and run late. So it's been a pretty awful year for the stock market. It's been a pretty awful year for the bond market. You add the two together, classic 60% stock, 40% bond portfolio. It's been the worst year since 1937, right? During the Great Depression. But it did not harm our clients, because our strategy says, first off, put half our money in growth stocks, half money in value stocks. Sometimes they win, sometimes they lose. On average, the two are going to mesh out. So in the last 4 years, our growth stocks outperformed value. We sold value, bought growth. This year, we benefited. So even though the FANG stocks were down 43%, our portfolios were down nothing like that. On the bond side, normally when stocks are coming down, bonds are coming up. This year, they both came down. All right, well, that's the bad news. The good news is we were getting extremely low yields on our bonds 2 years ago, like under 2%. Well, now that bond prices have fallen, yields have gone up. So now we're getting 4.5%, 5%. We're actually getting paid to own bonds for the first time since 2008. But meanwhile, the other thing that we always have in our mind is that these kind of bear markets happen frequently, every 5 years on average. We don't remember, but they do. There was one 2 years ago in March to May 2020. It was over so fast, no one remembers it at all. But also 2008, 2009, 2000, 2002, right? 1987, every 5 years on average. Well, when we design a portfolio to support someone's draw, we always have a certain amount of money in cash, about a year's worth, and another 4 years worth of money in bonds, another 5, and then the rest is in stocks. So normally stocks grow faster. We pour the excess of their stock portfolio to the bond portfolio, from the bond portfolio to the cash portfolio, and then each month we send a check. When stocks do badly, we just turn off the waterfall between the stocks and bonds, wait a year or a year and a half until they recover, and then turn the waterfall back on again. So terrible year for stocks, terrible year for bonds. Not one client experienced a reduction in their monthly draw because of market volatility, because that's what we do. That is our job. And so I'm going to stop there exactly at 6:31. And Buck, do you have any final thoughts?
No.
You mentioned that your family's coming around for Christmas?
They're coming down, and I can't wait to see everybody.
Terrific. We are going the other way. We're going to go visit my parents, head out with my sisters for New Year's Eve dinner. So on that basis, I wish you a Merry Christmas, Happy Hanukkah, and a Happy New Year.
Same to you and yours.
Good,
Thank you,
good night.
David.
Good night.